Two stocks I'm buying at the right price. This is a video that I've done every few months discussing two stocks I'm extremely interested in adding to my own portfolio. The only problem is they are a little bit above my fair value, which is why I give you my buy price, my fair value in the videos, and give you a very quick analysis on both of them. Now you might be asking yourself, why would you watch a video on stocks that I'm going to buy in the future? Why you don't want something I'm going to buy right now? Like, it doesn't make sense. And I agree with you, but I'm going to share something a little bit about my strategy with you here first, then I'm going to get into the two new stocks. And what I mainly do is I spend a lot of time trying to analyze stocks that I'm interested in. Even though they are overvalued, I add them to what I call my price alerts on Yahoo Finance. And I get notified whenever these stocks hit my fair value. And one example of a stock I've talked about in my previous video was Otis Elevators. I analyzed the stock. It was overvalued, but I loved the business model. I loved the company. My fair value was $76 per share, so I set up an alert at $76. A few weeks later, I forgot about the stock, but I got notified in the morning by Yahoo Finance that Otis Elevators hit 76 per share. So I opened my broker. It was $74 per share, and I looked at earnings very quickly. It took me 5 or 10 minutes because I already researched the stock, and I was able to buy in the morning. Now in the afternoon, the stock was already up 5%, so I bought it at $74 per share, as you could see in the screenshot, and a few months later, I've sold it around $93 per share. I made pretty close to 19%, 19.5% on this investment that I forgot about. So this is why it's important to do research on stocks, even though you don't want to buy them right now, but it could save you a lot of time and give you speed, which is extremely important, especially if you're buying a stock right after it goes down on earnings. This is normally the best time to buy because there's an overreaction in the morning. Sometimes this overreaction corrects itself in the afternoon. So I'm going to share these two stocks with the video. The first one is extremely interesting. I've never talked about. The second one is more popular, and you might have heard of it many times, but the first one is just unknown, and it's my kind of investment. And again, you might have never heard of it before. And this is a company called CHH, which is Choice Hotels. Now, as you could see from this chart, Choice Hotels has been within a very predictable trend. It goes to 131, 132, then it crashes back to 110, $109. So I know a lot of traders watch my videos. Maybe this is an interesting stock for you. Maybe it's an interesting setup for trading the stock. But one of the reasons why it's been trading in such a range was because this company was trying to acquire Wyndham Hotels, which I'm sure a lot of you know these hotels, a lot of you heard of the company. They were trying to merge with Wyndham Hotels, but it didn't go through, and they were giving them a hard time. So they decided to abandon the merger. So now financials are much more clear than they were before. So I don't believe Choice Hotels is going to keep trading in this range forever. But Choice Hotels is a hotel company that owns many different brands that you might have heard of. But before I get into that, I'm going to get into my very quick overview of the company that I posted a few weeks ago on Twitter. And this is, again, a hotel company, 34% return on invested capital, 18 times earnings versus 23 times earnings for the historical average, or historical mean multiple, I should say, 23 times earnings, 20% net income margin, 50% of the revenue is recurring. It's not just based off hotels if they sell them or they don't sell the rooms. 50% is recurring through systems and management and royalties, which I'm going to discuss, and it's very, very interesting with the stock. 15% average earnings per share growth. This is Choice Hotels. They own many different brands you might have heard of, more on the lower quality brands or mid-tier brands. They don't have anything that's just luxurious or anything upscale or anything you would enjoy being there and all that stuff. They mainly have, something good value for, a short period of time. Something like the Comfort Inn. Maybe you heard of these hotels, Country Inn and Suites, Quality Inn, Sleep Inn, Clarion, which I see a lot of them all over the road, Clarion, Equino Lodge, which is the lower tier end, Roadway Inn. They did acquire some upper scale brands. I wouldn't say luxury, but a lot of the Park Plaza by Radisson, mainly the Radisson brands, they acquired it in 2022. Cambria Hotels, not too bad, but nothing on the upscale. So it's more mid-size or mid-tier to low-tier kind of hotels, more on the affordable side, which should hold up better in recessions or in bad times. But a lot of people like to use these hotels like the Sleep Inn, Comfort Inn, Equino Lodge. If they're going from one state to the other, they want a few hours to rest on the road, to take a nap. They go into these cheap motels or hotels, for a short period of time. It's not the best quality, but they don't need it. They just want to spend a short period of time, take some sleep, and then get back on the road. So this is what these hotels are popular for in the United States. But they also have suites. So they have, the Wood Spring suites, which I've seen many of them, and they don't look too bad. And, they have many different stuff, but it's mainly on the lower end to mid-tier, which is not the highest margins, but the business model itself is actually amazing. So in 2023, they made $1.5 billion in terms of revenues. Now, out of the $1.5 billion, $75 million it was in platform and services fees. So these hotels on the front desk and their systems and their computers, they use a platform to check in guests, check out, do many different things. Choice Hotels provides the franchisee these platforms, and the franchisee have to pay Choice Hotels to use the platform. They can't use anything else. So it's more of a monopoly kind of stuff. And it grew over 18% year on year. Not bad for a hotel company. Now, out of the $1.5 billion, $513 million is for royalties, licensing, and management fees, because a lot of their hotels, they are owned by franchisees. They have to pay, royalties and franchise fees and other things to Choice Hotel. Same way you buy a McDonald's, or something like KFC or whatever, you have to pay them royalty fees and platform fees. And this is what Choice Hotel benefits from. Very high margin stuff, 9% year on year. The total revenue growth was 10% year on year for 2023. Not bad at all. Synergies, because they did some acquisitions, they exceeded their target by 6%. Pretty good. Earnings per share, diluted, adjusted, was 60% up year on year. I mean, pretty amazing stuff for this company, Choice Hotels, which not a lot of people know about. Now, in the last quarter, they issued guidance, and I have to say, I don't like it at all. And this is one of the reasons why I haven't bought Choice Hotels stock yet. In terms of earnings per share expectations for 2024, it's only 6%. This is down from 16% for 2023. This is, really, really bad, and I'm trying to pay attention to it. I'm going to tell you why I believe they downgraded guidance, but I talked about this a little bit. Return on invested capital is high, 31%, 34%, 24%. Pretty amazing stuff for the company. Amazing net income margins for a hotel company. Hotels have a lot of employees, a lot of staffing, a lot of utility costs and cleaning supplies and many different things. And because Choice Hotels, most of them are franchised, they collect the recurring revenue services from the software stuff and the royalties and licensing and all these kind of things. And they are trying to get more and more franchisees because it increases their margins much more than them owning the hotels and operating it themselves. So 20% net income margin for the current 18 times earnings is really not bad at all. And the mean, as I said, is pretty close to 24 times. Now it's sitting at 18 times. Now your question is, Choice Hotel sounds like an amazing investment. Why don't you already own the stock? And this is the reason, one of the reasons. And the first one is the balance sheet. They have $26 million of cash and cash equivalent, which is not much. But in terms of maturities, they have $499 million of the current portion of long-term debt, which meaning debt that's maturing this year in 2024. $499 million. The leftover long-term debt is pretty close to $1 billion. And if we take a closer look at the maturities of Choice Hotels, we can see that 2024, $500 million, nothing in 2025. 2026 is a $226 million, and the remaining of $842 million is due after 2028. So we really have to worry about the $499 million. Now, the good thing is that for the company, they don't have any major dividend obligations. Their dividend obligation is around $56 million a year, and they could easily cut the dividend. No one owns Choice Hotel for the dividend. It's not the best dividend ever. So they're pretty flexible with it. But $56 million free cash flow for 2024 is expected to be $322 million. This is mainly because they executed on a lot of synergies and cost-saving stuff from the last acquisitions that they did in 2022 and in 2023. And they're also going to pull back on CapEx, about $100 million, which is going to increase free cash flow, and it's expected to continue increasing over the future. And these are by more than 5 analysts. So I believe the 2024 guidance is pretty close to being accurate. So $322 million of free cash flow. You have the $50 million in dividends. This is something like $270 million left over. And the debt that's due is pretty close to $500 million. So I'm not sure what Choice Hotel is going to do. They will most likely have to refinance it, some of it in the future, and pay back some interest. But this is one of the reasons I'm not really owning it right now. And this is really going to affect their ability to do acquisitions and to do buybacks. They did a lot of buybacks in 2023, I think 7 or 8% of the market cap, which is really going to add a lot of earnings per share growth, of course. But whenever you cannot do any buybacks, there's no floor on the stock. The stock can keep going down. Dollar General had this problem. The stock was going down. They couldn't buy back stock. They had a lot of debt. Choice Hotel is in the same exact boat, but after 2024, they will have a lot of free cash flow to do acquisitions, do buybacks, increase the dividends, and do many different things. So for me, looking at Choice Hotels, amazing company at 18 times earnings, 20% net income margins, 30% return on invested capital. A lot of this stuff is recurring revenue services. It's still a small company. They have been doing and will continue doing a lot of acquisitions. I'm personally not willing to take the risk right now with the current balance sheet and everything else that's happening in the economy. So for me personally, to own Choice Hotels, I would love to buy it around 15 times earnings. Now it's at 18 times or high 17 times. I would love it around 15 times earnings, which is $103 per share. So for me personally, anything below $108 per share is a buy for Choice Hotels. I will likely be opening a position and dollar cost averaging down. I just really love the business model. I love the company. If you listen to the last earnings call and the few before, management is very, very smart with that stuff. They're shareholder friendly. They do a lot of buybacks, a lot of dividends. They do acquisitions. They know how to manage capital. And Wyndham, kind of merger would have been successful. It didn't go through, which is fine. So for me, not more than $108 per share. If it goes below it, I will likely be buying Choice Hotel stock. And I'm expecting 15% return annual from this investment, because I believe the future earnings per share growth will likely continue to be around 14-15% if they continue doing buybacks, they continue doing acquisitions and finding synergies like they've been doing. This is how it was before COVID. They were making 14-15% earnings per share growth, and I believe this is going to continue. But for me, paying 15 times earnings, and even if earnings per share disappoints, I'm in a much better position than paying 18 times earnings in case earnings per share disappoints. So this is why not more than $108 per share. And that's it for Choice Hotels. The second one is more of a stock that a lot of you know. It's a REIT, Real Estate Investment Trust, amazing company, good management. I would love to buy it, but it's not sitting at the right price yet. And this is a stock I've talked about. It's called ADC, Agree Realties. ADC is still trading at the same price it was in March 2020 and even all the way back to late 2018. And a lot of these REITs got absolutely killed, of course, because Jerome Powell wants to likely keep interest rates higher for longer. We might not get any rate cuts in 2024. This is, of course, going to affect REITs, and they would have to yield a higher dividend. Now, for ADC, a lot of you know the company, but they have pretty amazing tenants like Walmart, 6.1% in Walmart. They have in Tractor Supply, Dollar General, Best Buy, which I don't like, CVS, TJ Maxx, Dollar Tree, a lot of them Dollar General, O'Reilly's, which I love, Lowe's, Sunbelt Rentals, pretty amazing company. I used to own the stock before, Wawa, Sherwin-Williams, Home Depot, BJ's, and many different tenants. But a lot of them are pretty recession-resistant tenants, and the management is very smart in terms of allocating capital. For the balance sheet, they call it a fortress balance sheet. It is for now, and this is one of the reasons why ADC has not been crashing as much as other REITs that have a much worse balance sheet. For ADC, they don't have any major maturities due before 2028, which gives them an advantage over other REITs in the short term if they don't want to refinance at much higher interest rates. So this is the story with ADC. They do pay a dividend, and it's a monthly dividend. It's been increasing 6% over the last 10 years. Pretty amazing dividend growth investment. If you look at the shares outstanding, you can see the shares outstanding expanding. And this is a problem, but this is how it is with REITs. This is the business model of REITs. So in the case of shares outstanding expanding, you always have to look at per share metrics. So if you look at the adjusted funds from operations per share, which is a good metric to value REITs and to look at their performance, on per share basis, the value has increased from 2013 to 2024 pretty much every single year. So yes, they did issue some shares, but they created more value per share than they issued. And this is what matters with these REITs. So this is why I always get comments about shares outstanding going up. But if you have to look at it on earnings per share, if earnings per share, free cash flow per share also went up, that means they created more value than they destroyed with them issuing shares. And this is just the model of REITs in general. ADC is also trading at a discount. on a historical average. It's now trading around 13 and a half times adjusted funds from operations per share. It traded as low as 11 and a half times over the last 10 years and as high as 25 times. Now, I'm not saying we're going to go back to 25 times, but I would really see over the next 2 or 3 years, if interest rates come back to the neutral rate that Powell said it's 2 to 2.5%, unless nothing changes, I would realistically expect ADC to get back to 17 and a half times, which was the mean over the last 10 years. So this is a potential multiple expansion for ADC, and the current dividend for ADC is 5.5%, and this is the reason why I don't own it. I would prefer if ADC yielded 6%, because I can get 5 to 5.5% putting my money in short-term stuff, or even leaving them in my broker. A lot of brokers pay 5 to 5.5% interest on idled cash, risk-free, which is pretty amazing. But ADC is growing. They grow adjusted funds from operations per share around 4 to 5% every single year. So I would expect 4% growth every single year. I would expect a multiple expansion from 13.5 back to 17.5. And if the company does yield 6%, I would just feel better and I would be more comfortable owning ADC if I'm getting 6% and I'm getting something a little bit above, whatever I can get just having short-term stuff, even though ADC is growing. But if ADC gets to a 6% dividend or around $50 per share, I would be very interested in opening a position in ADC and get paid 6% while I wait for interest rates to come down. It might not be this year, it might not be next year, but eventually it's going to come. And in the meantime, ADC would be growing and acquiring more and more tenants and doing a lot of more things. So I love ADC at $50 per share. If we get close to 50, I would be very interested in buying the stock. Now, I just have to say that these are the prices I'm interested in buying them, but maybe something changes. Maybe I find something better. Maybe I do something else. So this is why I have my own group, so I can share everything I do live in real time. And if you're interested in joining, the link in the description. But if nothing changes, I will be buying Choice Hotels, around $108 or below. I will be buying ADC pretty close to $50 per share. And I hope you don't copy me. I hope you just, see what I have and then do your own research and, determine a buy price for yourself. Or maybe if you don't like the company, it's fine. But this is my strategy in terms of what I do with my watch list, price alerts, and how I do it. So thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.